In 1997, a federal tax court handed real estate investors a method to legally eliminate six figures in taxes overnight. And in the nearly 3 decades since, no bank, no middle-class accountant, no government pamphlet has ever explained it to you. That silence wasn't accidental. By the end of this, you'll understand exactly who decided you shouldn't know. It starts with a quiet ruling. A hospital corporation in Tennessee took the IRS to court over how their buildings should be taxed. The case was dry. The attorneys were expensive. The courtroom was not crowded. When the decision came down, it didn't make the news. No press conference, no legislation, just a ruling that slid into the federal record and began doing its work. On one side of the table, institutional investors, large developers, the kind of people who hire full floors of accountants. On the other, everyone else. The ruling was called cost segregation, and the people who already had money found it immediately. Here is what cost segregation actually does. When you own a building, a rental property, a commercial space, a small apartment complex, the IRS forces you to depreciate it slowly. Residential property, 27.5 years. Commercial, 39. That is the standard schedule. You get a small deduction every year, barely enough to notice. But inside that building are components the tax code allows to depreciate much faster. Electrical systems, certain flooring, plumbing fixtures, land improvements. A cost segregation study performed by a licensed engineer breaks the building into those individual parts, components that qualify for 5-year depreciation, 7-year, 15-year. Instead of waiting nearly 4 decades for your full deduction, you front-load it. Year 1. A $500,000 rental property can generate $80,000 to $120,000 in deductions in a single filing. That is not a loophole. That is not a gray area. That is the exact reading of the existing tax code. And it has been there this entire time. The official explanation for why you've never heard of it is simple, too complex for the average person. Cost segregation studies cost money. They require an engineer. They're designed for large commercial investments. That's what the financial industry will tell you if you ask. But the explanation falls apart. Studies typically run between $5,000 and $15,000. On a property generating $80,000 in first-year deductions, that cost evaporates in the first quarter. The complexity argument is not wrong. It is irrelevant. Your tax preparer knows about bonus depreciation. Your tax preparer knows about accelerated schedules. The firms advising real estate investment trusts have filed thousands of these studies. The information was never missing. It was just never aimed at you. Now watch what happens next, because this is where it stops being oversight and starts being a pattern. In 1986, 11 years before that court ruling, Congress passed the Tax Reform Act. That law extended depreciation schedules, stretched them longer, harder to use. It was sold as simplification, as fairness. What it actually did was create the conditions that made cost segregation indispensable for anyone positioned to understand it. The longer the standard schedule, the more valuable the shortcut. The reform didn't harm investors with access to sophisticated accounting. It handed them a larger gap to exploit. Then in 2004, the IRS released its own cost segregation audit techniques guide, a public document on a government server, available to anyone who searched. It explained exactly how this works, who qualifies, which components fall under which schedule, how the studies are structured. It has been there for 20 years. Almost no one went looking, because almost no one knew to look. In that same 20-year window, the average American's real wage barely moved. The tax advantages compounding inside every institutional real estate portfolio didn't move. They accelerated. $600 billion in real estate changes hands in this country every year. The people commissioning cost segregation studies have been running a compounding advantage, legal, documented, and deliberate, since before most of their tenants were adults. Think about who is actually in the room when one of these studies gets ordered. It is not the person who bought a duplex to supplement a salary. It is not the retired teacher who inherited a rental property and is trying to figure out the paperwork. The firms that do this work market to developers, to real estate funds, to top-tier accounting practices with high-net-worth client lists. The middle-class investor, if they own a rental property at all, is filing with a preparer who handles W-2 returns and standard deductions and has never once commissioned an engineering-based depreciation analysis. The gap is not knowledge. The information is public. The gap is access. And access was shaped deliberately by an industry that decided certain clients were worth a phone call and certain clients were not. 40 years of that decision compounds, silently. And it is still compounding right now, so here is what I want you to sit with. The IRS guide is still there. The ruling hasn't changed. The 5-year and 7-year component schedules are still in the code. If you own any income-producing property, you may have already qualified for deductions you never took. Years of them. 3 years of amended returns are still open right now. The question isn't whether this was hidden. The question is what else is sitting on a government server at this moment. Documented, legal, and aimed at everyone except you.